Now, as we turn to Europe, we first want to start off with what is happening in Europe with electricity, with the shortages. Putin came out today and said that he's going to make available natural gas at contractual levels coming through the Ukraine, coming through Nord Stream whenever it comes online. And the reason why is because there's electricity prices have gone through the roof. And we're talking about record prices, and not record prices by a small amount. We're talking 100, 150% increases. And we want to look at what are some of the mixes, because when you look at oil, you can see just the amount of energy consumption by fuel type. So when you look at how much coal is being used, the issue that remains is the carbon cost. So there's a lot of regulations that come into play. There's a pipeline regulation where if you have to own it the whole way through. There's a carbon regulation where you have to pay for the amount of carbon that's being used. So here's where you're seeing a lot of these dynamics, and especially when you start looking at Norway, given the amount of hydro, they're at a record low for the amount of water that's available. When you look at a lot of these areas, the question is going to be how much additional oil burn could you see versus coal? And that's where natural gas has taken some of that demand, but how flexible is that? And some of them don't have the dual capacity, some of them maintained it. So there is some of that flex that can come from the natural gas side versus, because a lot of those renewables, if you think about the renewable side, which has continued to expand over the last few years, they're being backed up by natural gas. But they didn't build renewables and then natural gas flex. They just built natural gas. So some of the natural gas that was built separately does have that flex, but not all of them, which is one of the things that is key when you're looking at how much oil can be consumed. And by oil, it's usually gas oil, diesel, fuel oil. And just given the regulations, ultra low sulfur diesel, you're starting to see some of that setup that is going to be interesting to see what that pivot is as they try to increase the amount of available natural gas to avoid having to burn coal, additional coal or oil, because the carbon offset is going to be massive and very expensive versus what natural gas would be. But as we sit right now, looking over the last 10 years, you get an idea of just how low the storage is for Europe. Now, some of this, it's not all the same. Some places have a decent amount of natural gas in storage. It's just certain countries, one of them being Germany, is at one of the lowest it's ever been. And the problem is they were waiting for Nord Stream, but they're also the biggest producer on an industrial level. And the industry needs natural gas from a petchem perspective, from just keeping the lights on. So you're seeing some of this dynamics. But again, this is putting them in a very dire situation given the amount of natural gas that is missing from the system. And given where things sit, they might try to go out and purchase additional cargoes, but China's also purchasing cargoes. So there's a lot of competition in the spot market, especially on the LNG market, to make up for these shortfalls. Which is why when we look at another day of very high electricity prices across continental Europe and the UK, Spain and Italy, once again above 200 euros per megawatt hour. Prices in Germany are very high too. And a side day head reflected in the map, 1 year forward, also hit an all-time high in Germany. So it gives you an idea of just how expensive this power gen is. When you look at Spain, 203 euros a megawatt hour, Italy, 206. You're talking about a significant amount of cost, which is why industrial companies are struggling, because these are massive costs that they're already taking it on the chin in terms of import costs, like their raw materials, their labor, how they're just sourcing all of these pieces. This is from shipping delays, from containers. Now they have this hitting them over the head again, which again is creating this undue pain that is going to have to be adjusted in some shape, way, or form. And that water shortage on the Nordic hydro balance plunges to that negative 20 terawatt hours because you're seeing these shortfalls. You're seeing these reductions, which as the hydro doesn't flow, then you have to worry about, well, can you use diesel to back it up or natural gas? And this is that conundrum that we sit in to see how quickly they can try to turn this around. And then electricity and gas bills are going to squeeze household disposable income. This is what we continue to talk about when we look at global consumption. When you look at fuels for private transport, 3.3% of pretty much across the board. Electricity, 3% across the board. This is going to be a huge overhang for the consumer because they're going to try to pass down as much cost as possible, which is just going to take additional value away from the consumer. It's going to take wages. It's going to drain some of that savings that have been built up in order to just essentially try to maintain some sort of normalcy in the system. But Europe sources most of its coal from Russia. So if you think about where a lot of the coal comes from, not only does Russia sitting there and is offering some sort of ease on the natural gas side, they also provide the coal. So now you have all of these different backdrops. And it's funny, as we're talking about this, there's an article that comes out saying Russia offers to ease Europe's gas crisis with strings attached. Putin intervenes in market on a day when prices jumped 40%. Nord Stream 2 could help stabilize Europe's market. So what does that mean? You have to approve it because so far they've continued to delay the approvals, which again has created some of this backdrop. But even if they don't approve it, even if they sit there and say, we refuse to use Russian gas, well, are you going to use Russian coal? And how much does coal cost? Because even when prices were over $400 a megawatt hour, it still didn't make sense to turn on carbon because you have that overhang caused by the carbon offset cost. So which something's going to have to give to try to protect where prices are and what the prices are being realized at the consumer level. All the while, what do we have going on? Well, when we look at the Eurozone aggregate, let's turn to CPI. CPI is still sits there at 1.9%, continuing to go up. CPI estimate year over year up a tick to 3.4%. The investor confidence dipped. It was expected at 18.6, came at 16.9. But let's look at PMI. So Eurozone PMI expected at 56.3, came in at 56.4. Composite was expected at 56.1, came in at 56.2. Very stable, as we've been talking about. And then the PPI continues to grind higher. PPI month over month was expected at 1.3, came in at 1.1. Year over year was expected at 13.5, came in at 13.4, but that was August. And we know prices went back up in September, so we're still going to see that continuation. And then retail sales did recover in from August, which hit a low. So then when we look at Germany, you can see that CPI came in just below estimates, sitting at about 4.1%. Retail sales missed in August, which we know rebounded in September. But then when you look at German manufacturing, expectations were for 58.5 on the manufacturing side, came in at 58.4. Services slightly better, expected at 56, came in at 56.2. The composite coming in at 55.5. So that's something that we continue to see fairly stable, with more pressure coming on the manufacturing side as services stay fairly, firm, if you will, based on where things are going. Factory orders fell in August, was expected to be down negative 2.2%, came in at negative 7.7%. But German construction PMI came in at 47.1. So you still have some of that contraction, and again, you're still seeing those factory orders come down as the manufacturing slows, given the issues that we're seeing on deliveries and just the underlying market in terms of just trying to get anything on the supply chain level. So then let's talk Italy. So Italy, CPI very much in line with where things were. Manufacturing PMI was expected at 59.5, came in at 59.7. Services PMI expected at 56.5, came in at 55.5. And then the composite was expected at 57.7, came in at 56.6. So this is where we see a flip, where manufacturing comes down and services see a little bit of a bounce, which is what we expect. So realistically, the composite will be the same, but based on what we're seeing right now, services are continuing to move up a bit, but there's additional headwinds coming in on the manufacturing side. And now when you turn to France and you look at PPI shifting higher versus prior, it was expected at last month was at 8.6%, came at 10%. CPI coming in right in line. Industrial production, up a bit in August, which remained strong going into September. Manufacturing production similar, but then France services PMI was expected at 56, came in at 56.2. Market composite was expected at 55.1, came in at 55.3. So the France services is continuing to kind of be that stabilizer. It's the manufacturing that we saw roll over again. And again, not contractionary, but that's where we saw additional overhang as we came into the October months. And then Spain, when you look at retail sales coming in a bit lighter, that actually continued into September in Spain. And then when you look at manufacturing PMI, expected at 58.2, came in at 58.1. Services PMI expected 58.2, came in at 56.9, giving the composite coming in at 57 versus the estimate of 58.3. So again, the manufacturing is going to come under pressure. We're seeing that again. Services will get a little bit of a bounce. And that's where we continue to see this kind of input, this balance of things staying fairly stable in general as we kind of continue through the remainder of October. But the German import price index continued to drift higher in August, which continued in September, which again is going to be some of that additional pressure that we've been talking about. Spain, something very similar. When you look at where things were expected, 3.6%, came in at 4%. Then when you aggregate all of this together and you look at the inflation overall, non-energy goods contributed continued to go up. So not only are we going to get energy contribution, that blue line is going to explode, but you also have the non-energy goods that are continuing to go up as you see service contribution. And remember, services had a big dip, and big being relative, a big dip in PMI, which we saw some recovery, which again is going to support pricing and is going to push inflation ever higher, even as we have some of the other side on the goods get a little bit cheaper. But household saving rates have continued to fall. They're still well above where they were pre-pandemic, but as you see, these saving rates are going to get just decimated by the, again, just based on inherent cost that is hitting the underlying consumer. And all of that is leading to, when you look at China, imports from the Eurozone have slowed, which is going to put additional pressure on Europe, but more importantly, Germany, when you look at just where some of these shifts are going to be in general, which is why in the next segment, we really have to look at what is happening in Asia and more importantly, what is happening in China and how is that going to continue to reverberate through the system. And we actually expect Chinese imports from the Eurozone to go negative, which is going to put a bigger weight or anchor on where that growth is, and more importantly, manufacturing PMI, because we expect new orders to fall and just inherent activity to be under pressure, which will to a point be offset by an increase in services, keeping composite fairly flat. Just the mix is going to adjust. But we'll talk about that more in the next segment.